Florida's luxury condo market just recorded a 12% year-over-year price drop, with foreclosures up 25%. And yet, cash buyers are flooding in. Is this the perfect storm or the next big trap? If you're watching from London, Sydney, Toronto, or New York, you need to understand what's really happening in Miami and whether now's the time to act. In this video, we'll unpack the data behind the crash, reveal which neighborhoods are offering 5.5% plus rental yields, and show you how to position your portfolio before institutions return. Stay with me, because in the next few minutes, I'll reveal how smart investors are turning Florida's chaos into cash flow. Current market conditions. Florida's luxury segment is repricing. Let's start with where we are right now. As of Q1 2025, Miami's luxury condo market, defined as units priced over $1 million, has seen a 12% decline in median prices year over year, landing around $880,000 according to Redfin. CoreLogic reports a 15% drop from peak 2023 values, with high-rise units in Brickell, Edgewater, and Sunny Isles hit hardest. Take a look at this chart. Luxury condo price decline, Miami 2023 to 2025, and you'll see how steep this correction really is. The luxury inventory pipeline is also overflowing. Miami-Dade now shows a 6.2-month supply, triple what we saw in 2022 when buyers were bidding sight unseen. That oversupply is putting serious pressure on sellers, especially those who financed near the top of the market. Causes. What triggered the downturn? So what caused this sharp correction? There's no single trigger. This was a perfect storm of economic tightening, migration slowdowns, and luxury overbuilding. First, interest rates. The Federal Reserve has held steady at 4.5 to 5%, which has pushed mortgage rates to 6.7% plus on jumbo loans. For a $1 million condo, that's a monthly cost increase of over $1,500 compared to 2021. Second, migration trends are shifting. Inflows from New York and California into Florida, one of the core drivers of the luxury boom, are down 20% from their pandemic peaks per Redfin. Third, we've seen a surge in new inventory and speculative development, particularly in branded towers and luxury waterfront projects. Many units sat unsold for months, and now those developers are cutting prices or offloading bulk packages to funds. And finally, we're seeing early signs of distress. ATTOM data shows 1,200 foreclosure filings in Q1 2025 alone, up 25% from last year, with luxury addresses increasingly represented. Take a look at this chart, Miami-Dade foreclosure surge, Q1 2025, and notice how even top-tier buildings aren't immune. Impacts. What this means for investors. Now here's where it gets interesting. For the right type of buyer, this reset is opening rare windows. We're already seeing institutional players quietly accumulate inventory. Vanguard's Q4 2024 report noted that funds acquired 20% of all distressed condos sold in Miami, with a strong tilt toward long-term rentals over short-term Airbnb models. At the same time, rental yields are improving. Redfin reports that gross rental yields on Miami's luxury units now average 5.5%, up from 4.3% a year ago. Why? Short-term rental demand is cooling due to oversaturation and local regulation, pushing investors to lock in year-long leases with corporate tenants and HNWI renters. Take a look at this chart, Miami rental yield growth 2023 to 2025, and you'll see how quickly the fundamentals are shifting in favor of yield-focused strategies. Liquidity is bifurcating. According to Zillow, 35% of all Miami luxury condo sales in Q1 were all cash, up from 25% last year. In other words, serious players are moving while leveraged buyers are frozen out. So where are the actual deals? If you're buying from the US, UK, AU, or CA, here's what I'm seeing. Brickell and Sunny Isles, distress with yield. These are ground zero for pricing pain, but also where the best rental upside is emerging. We're seeing bank-owned condos trading 15 to 20% below market, with full amenity packages and ocean views. Edgewater, mid-luxury with undervalued rentals. Slightly less saturated than Brickell, Edgewater is drawing interest for $700,000 to $900,000 units with stable HOA fees and 5% plus yields. Pre-construction fire sales. Developers are quietly offering up to 15% discounts for bulk buyers or international investors willing to close quickly. If you're cashed up, these deals are rarely public. Cross-border arbitrage. Relative to Toronto or London, Miami now looks undervalued. CAR-EA reports a 5% drop in Toronto condo prices year over year, while Zoopla shows London's market flat to negative. Factor in a strong USD, and your purchasing power in Miami just improved. Take a look at this chart. Global condo value comparison, Toronto versus Miami versus London, 2025. And you'll see the value spread widening fast. Here's how I'd play this as a serious investor. 1. Go all cash or close fast. Cash is king when markets crash. Sellers are prioritizing speed over price. If you can close in 10 to 15 days, you're already ahead of institutional timelines. 2. Buy below $1.2 million to avoid institutional bidding. BlackRock, Greystar, and others are targeting blocks of units at 1.5 million plus, leaving the 800,000 to 1.2 million space wide open for individual buyers. 3. Focus on 5% plus gross yields with potential for rental appreciation. Look for condos with minimal restrictions on leasing, low HOA volatility, and proximity to long-term demand drivers like universities, medical centers, or Fortune 500 campuses. 4. Use tax-efficient structures. U.S. investors, 1031 Exchange is your friend. UK and AU investors, plan for CGT exposure and repatriation strategy. Canadians, no SDLT equivalent, but currency hedging is a must. 5. Time. Your entry, but don't wait too long. From what I've seen in cycles past, the window between panic selling and institutional recovery is tight. JP Morgan projects prices could fall another 5 to 7% by Q3, but once inventory clears, recovery can be swift. And check this out. Projected recovery curve, Miami luxury condos Q3 2025 to Q2 2026. The rebound potential is already being priced into some investor models. Let me share a move that's already played out. In mid-2024, Greystar, one of the largest U.S. multifamily developers, acquired a portfolio of 500 distressed luxury condos in Miami, according to Reuters. They paid an average of 18% below market, closed 80% in cash, and immediately converted units to long-term rentals targeting 5.8% yields. Their timeline? A 24-month hold, banking on price normalization, and a yield plus appreciation exit by 2026. And here's the thing, this isn't a billion-dollar only strategy. If you had $2 million, you could have done 2 or 3 of those deals individually, with the same margin and faster flexibility. So far, we've covered why Miami's luxury condo market is cracking, where the data shows the bottom forming, and how international investors can get in ahead of the next cycle. In just a moment, I'll summarize the 3 biggest takeaways and show you one final chart that highlights why cash buyers are already outperforming in 2025. Stick around. This final section could be the edge you need to make your next big move. And before we wrap up, I want to leave you with one last strategy that's proving effective for investors in 2025, even in this declining market. It's simple but powerful. Buy where institutional capital hasn't fully arrived yet, but is already circling. In markets like Miami, we're seeing smart investors step into that gap, targeting sub 1.2 million units that fly under the radar of the big funds. Take a look at this chart. Cash buyer advantage. Miami luxury condos, Q1 2025. It shows how individual investors are outpacing institutions when it comes to speed and deal access. From what I've personally seen working with investors in Florida, the ones who act early, before the bottom is obvious, are the ones who win big. You know how fast things move in this market. Waiting too long can mean getting priced out by the next wave of institutional money, especially as rates begin to ease and confidence returns. So let's recap a few key takeaways before you go. First, foreclosure rates in Miami are climbing, and luxury condos are at the center of it. But where there's distress, there's opportunity. Second, rental yields are recovering fast, especially for long-term leases. Miami's 5.5% plus gross yields are already catching global attention. Third, institutional players like Greystar and Vanguard are quietly positioning, but they're not everywhere yet. That's your opening. Fourth, cross-border advantages are real. A strong USD means better purchasing power for UK, AU, and CA investors right now. But currency moves won't favor you forever. And finally, timing matters. The data points to Q3 2025 as a likely bottom. But the best deals are happening now, before headlines confirm the recovery. Acting now means you can lock in strong rental income, pick up assets at a discount, and stay ahead of the recovery curve. Delaying might mean watching these windows close from the sidelines. So let me ask you, are you actively looking at Miami, or are you waiting for more signs? Which global market do you think holds the most upside in this cycle? Let's talk in the comments. And if you don't want to miss the next wave of profitable real estate opportunities, from London to Brisbane to Austin, subscribe to EstateScope right now. We're here to bring you the clearest, most strategic insights for real investors, not speculators. Like this video if you found it valuable, and share it with someone serious about investing in Florida real estate. Until next time, stay sharp and stay ahead.